Investing in equity, it's an act of faith. It's faith in the future. If in next 10 years we believe we will be a better world, make sure that you don't run away.
Hello and welcome to Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, a 10-year SIP starting today will end in 2036, and between now and then, we'll see multiple recessions, maybe a war that no one expected, and multiple corrections. We know this because we've seen all of this pan out through the last 10 years. And despite that, a 10,000 rupee SIP in 2016 turned into something around 28 lakhs over an investment of 12 lakh rupees. So today, the SIP plan that survives all of that, 3 funds, 1 step up, and 1 rule. Dhirendra, welcome to this discussion.
Thank you.
So let's begin with the most basic question. Why is 10-year a magic figure?
If you look at most 10-year time frames, you see a full cycle. You have, if you look at the recent past 10 years, you have seen COVID. If you look at the block of the previous 10 years, you would have seen the global financial crisis, some calamity. It would have gone through recession. It would have gone through good times, bad times, and some horrible times. And market would have come to a point in between in any 10-year phase where it looks like it is the end of the world. Things will never be the same again. Despite all these, in any given 10-year period, you have not only earned positive returns, you have never lost money. And on any given 10-year period in the history of Sensex, and that is about 40 years, not only you have earned positive return, mostly you have also beaten the then prevailing fixed income return. So this is the magic of compounding. This is the magic of equity. This is the magic of beating fixed income. Despite all odds, despite all upheavals, you still win.
Okay, so 10 years because that's a full market cycle.
That is a full market cycle, and investing in equity is a matter of, it's an act of belief. It's an act of faith. It's faith in the future. But 10-year period, you generally end up being well off.
Right. So if someone is starting today with a 10-year period in mind, what goes into it?
10-year itself, it creates a great advantage for you. I am reminded of a very unusual answer by Warren Buffett. Jeff Bezos asked him once that your strategy is so simple. Why not too many people follow it? Warren Buffett coolly and smilingly and wittily, with a wink, he said that because nobody wants to get rich slowly. And that is the whole story for the 10-year SIP.
All right. So SIP for 10 years is a guaranteed way to get rich slowly. But where should one invest?
I'll give you 2-3 plans. One is the simplest one. And that's the foolproof one. The first plan is primarily to acclimatize yourself, making sure that you will stick around for 10 years. Because 10 years, and so many people know, but it gets very hard for people to stick around for 10 years. For anybody who is 35, 40 years old and has never invested and is a scared person and is with great difficulty is going to invest, start with an aggressive hybrid fund. Start a SIP. Do it for 3 years, then add another aggressive hybrid fund. That's the way. And you are getting 75% equity, 25% fixed income. And every time the market falls, the fund rebalances, no tax incidents. Keep it simple. This is the simplest way of achieving this. And every 3 years, add another fund and stop at third fund. Don't add more than 3. And so you will be able to achieve this goal. Second is that there's a person who is getting started and is young and is very confident and is, very confident about of his income, his growth and future, and will not be very upset. Is generally venturesome. He can well start with a multi-cap fund and keep it simple. Choose a good multi-cap fund and be at it. Same thing. Keep it to one fund. After 1.5 years, add another one. And after 2-3 years, add another one. And if these 3 funds remain good, keep investing more in these. Adding more than 2-3 funds is not going to add any meaningful value.
Multi-caps, all of them?
All of them.
Okay.
And so here you are getting a full market exposure and you are choosing carefully. You are looking for funds which have the potential or have the track record of beating the benchmark. And that is what I'm aspiring for. And if you can't do any of these two, if you can't choose a good aggressive hybrid fund, if you can't choose this one, multi-cap fund, then look for one index fund. a Nifty 50 or a BSE 500, and invest half of your money there. And the other half, look for a multi-cap fund. You'll be getting a full market exposure, and every 2-3 years try and add that multi-cap fund and increase the amount in the index fund, because the second index fund is not going to add any meaningful value. It will be the same index fund, just an entry will change. So these are the simplest plan to build a portfolio for the long term. These are very low maintenance portfolio, and this is also a very tax efficient portfolio. The beauty of mutual fund is that whatever the mutual fund manager does, he grows your money, he buys and sells stocks, does whatever. You don't pay any taxes till you realize it, and you need it after 10 years.
Yeah. So ideally, what amount and how does a step up work?
As much as you can for the long term. The simplest way of doing as much as you can is that do your budget and invest before you start spending.
Yeah.
The day you get your salary, if you have something in your mind that you are earning 100 rupee and you're going to spend something like 70 rupees, invest the 30 rupees and do some liberal estimate of your spending and invest that money, because the money lying in the bank account is accessible. It is tempting. And then you tend to get a little impulsive with your spending, and there are just too many avenues to spend. Not to say that inflation is also a big tax on everyone. You always have more needs than the resources. So unless you are able to discipline yourself with a preset investment ahead of expenses, you will never get started.
And what is the case for step-up SIPs?
Step-up formula should be the minimum of your growth in income. If you are getting a 20% raise or 15% raise, then make sure that investment also rises.
Okay, now we're talking about a 10-year period. There will come a time when the markets will fall by 20% or 30%. What does one do then?
Whenever the market will go down, and when you have preset your goal that it is 10 years away, it is 15 years away, it is 20 years away, any market fall should make you happy, because that is when you are buying cheap. And you should be hopeful that when you need the money, the market will be up, which generally is. All you have to do is the first fall which you encounter after your money has grown something meaningful, is that you have to stop looking at the market. Make sure that you don't run away. Because stopping your SIP, taking your money out, is ensuring that you will be thrown out of the market at the most inopportune time, never to come back again. And it will leave a sour taste which will ensure that you never come back again. You have to overcome that first crisis. And if you are able to stick around, then you will it will become self-evident to you that market is like this only, and it's going to remain like that.
So one crash, if you stick around after that, you're likely to stick around for that 10 years.
Yes, you'll get over it.
You'll get over it. Now, coming closer to the goal, if just 2 years left for you to reach the goal, what should one do then?
As you get closer to your goal, the whole idea of this market is not a bankable thing in the short run. If you are investing generally, that you invested for 10 years, but it can still stick around, you can stick around and you don't need the money for a goal, then let it be there. Carry on with your plan. If you can invest more, carry on, continue. It's not a 10-year deposit that you have done a 10-year SIP. But if the money was set for a year marked for a goal, then you have to prepare methodically. Make sure that your first year expenses, estimated expenses, budgeted expenses, has been taken off from the equity 2 years ahead and kept in a fixed income fund, so that you can mount your SWP from that fixed income fund. You can't depend on equity for the last moment. And that is what most individual investors should do. For everybody who is doing some careful planning, accumulating and managing your cash flows, investing and turning it into a capital, you should have that capital turn into a supporting cash flow for you well before you need it, not for the last day, because you could be in for a big surprise. If you think that you need it in March 2026 or March 2027, and you will take your money out in January, that could throw up completely off balance.
But what if the markets are booming in the 8th year?
That is where your discipline comes in. You have to be focused on your goal. And if it is not for a goal, then ride the boom. But if it is for a goal, you can't have your firm plan based on something which is unpredictable.
So markets are unpredictable in the short run, but if you stick around for 10 years, you're likely to come out triumphant. That's all we have for you in this episode. Keep watching the space for more information. Thanks for watching. Bye for now.